Hi guys, it's Bullish Villa Academy here again. So in today's class, I'll be teaching you how to identify and mark out key levels in Forex. How to identify and mark out key levels in Forex. Now, this has been one of the greatest challenges of a lot of Forex traders. A lot of Forex traders that can trade very well. They have good psychological management, they have good risk management, they have the technical analysis in place and also fundamental analysis. But when it's come to identifying key levels in Forex, it is always an issue. And because of that, the market has always been taking advantage of that gap. So in today's class, I'm going to be simplifying this important topic to us. Now I want us to listen attentively from the beginning to the end of the class. So the teaching I have for you today is very loaded and you don't want to miss out. So I'm going to be walking you through it one after the other. The first thing we are going to be doing is that we'll be looking at what do we mean by key levels. Then the second thing we'll look at the importance of key levels. We'll look at some examples. Then we are also going to be looking at liquidity, external liquidity. We are going to be looking at flip zone, or we are secondary point of interest. We are also going to be looking at strong lows and highs, or primary point of interest. I know some of you are not familiar with this type, so I'm going to be breaking down all these things for you. I'll be breaking it down in a well simplified manner. So what I just need you to do is to listen attentively and stay to the end of the class. And also, once you are done with all this, I will now take you to the chart where I will now show you live examples of what I've taught you here. So I need you to listen attentively and stay to the end of the class. You understand? Listen attentively and stay to the end of the class. And even after you are done with the video, after you are done watching the videos, go on the chat yourself, go and backtest. You understand? Also come back again, watch again. So there are some videos that you don't watch once or twice. You have to keep watching them until you get it. You understand? So there are some videos you watch once, twice. Once go to the chat, once you trade, you made some mistake. That means you've still not gotten it yet. So you still have to go back and practice it again. Go back again, watch it again, then go and practice, then come back, watch it again and practice. So there are some videos you watch over and over again until you get the point. So without much ado, so let's dive straight into what we have for today. So we have how to mark key levels in Forex, or how to identify and mark key levels in Forex. So number one, what do we mean by key levels? So key levels, as we have it here, key levels, they refers to important price areas on a chart where the market has historically shown strong reactions. They show you where price is likely to react, so you don't trade blindly. Now, price often pauses, reverses, or accelerates at these levels. You understand? Now, for instance, now if you look at what we are having here, if you look at the diagram we're having here, this is a consolidated or a ranging market. If you look at it closely, below here we have the demand. This is the demand level, and this is the supply level. So at the demand level, we are looking for buying opportunities. At the supply level, we are looking for selling opportunities. So now, if you look at this level, you will see that price has come to test to mitigate this level and bounce back several times. Can you see? Price came to mitigate, test it here and bounce back, came to mitigate it. Can you see? Bounce back, came to test it again and bounce back. Can you see? Came to test it again. So price has come to test this level times to that number, and whenever it gets to this demand, price couldn't break out of this demand. It was not able to break out, so then it went over. Understand? And that's it. That was the same thing that we have at the supply level too. Once price gets to this level, can you see? Price bounced back, price went up again, got to this level, bounced back, got to this level, bounce back. Can you see? There's always a bounce back. So now, what is this trying to tell you? This is trying to tell you that this demand level is a key level, and this supply level is also a what? A key level. This demand level is a key level, and this supply level is also a what? It's also a key level. So now, once you discover that price has been mitigating a level more than once, then you're expected to take note of that level, because price will always come back. It will always come back to mitigate that level again, or it will always come back to kiss that level again. Then it will bounce back. Can you see? We have the first level here, the supply. Price got here, we tested it, came down, got to this level, bounced back, got to this same level again, we tested it. So from this second point where price has tested this level, it tested it at this place, which was the first time, came to test it again at this second place. So this is the place where you now have to come here and pick your trend line. You can see, click on your trend line, then you come and draw. This is my trend line already. You draw it. Now the reason why you are drawing it out is that you are anticipating that, okay, when price comes back later on in the future to retest this level, price might respect this level. You understand? Price might respect this level again, and that is why you are drawing your trend line out. You are drawing it out. You are drawing it out, anticipating that since price has tested it once and twice previously, it might likely come back to test it again in the future. Can you see? So you can see that price came the third time, tested it and bounced back. So as price has tested this level now and is bouncing back, so you are looking for selling opportunity. And the same thing happening at this demand zone too. So this demand zone, now we have demand zone, or you call it the support zone. You have the supply or the resistance. So at the demand zone now, you see you have your trend line. You have drawn it out. Can you see? You have drawn it out already. So now the price came at the first time, tested this level, bounced back. Price came back again, tested it the second time, bounced back. So once you have discovered that price has tested a level more than once, you come to your trend line, you draw it out, you draw it into the future. Now the reason why you are doing that is that you are anticipating that price will come in the future to test that level, and once that price comes to test that level again, you are anticipating that, okay, once price comes to test that level again, it will always bounce back. And that was what happened. Look at the first time, second time, then the third time. Can you see? Price came to test the level again and bounce back. And once you see that price is bouncing back, it is a great opportunity for you to look for your buying opportunities. And the same thing happened here too. Price tested this level and started bouncing back. So it is an opportunity for you to look for a buying opportunity. Now, another name for key levels can also be a zone, or area of interest, or point of interest. So you can call it an area of interest, you can call it point of interest, you can call it a zone, or you can call it key levels. So there are different names you want to call it depending on what you want to call it. So key levels, zones, area of interest, or point of interest, POI. Understand? So that I'm giving you all these names so that once you are outside with other traders and they are calling these terminologies, you know that they are actually saying the same thing. So your point of interest, your area of interest, your key levels, or your zones. You understand? So now this what we have here now. For instance, this example we have here now. This can be on a higher time frame, probably 4-hour time frame. Now the first thing is you locate the key levels which you have located. Then the second thing is, for instance, now this is the supply zone. This is where the market close. So imagine we now have price giving us a bearish interest that wants to come down from here. So that means you'll now be looking for a selling opportunity. Can you see? It's giving us a bearish interest that won't start coming down. Can you see? You'll now be looking for a bearish opportunity. But what you do is that, for instance, this is on a higher time frame. So you can't just start entering your sell here. So you have to now go to your lower time frame and now check for entry level. You have to go to your lower time frame and now check for entry level. And now your lower time frame can be 1 hour or 15 minutes. So probably you went to your 15 minutes. So once you get to your 15 minutes, now you want to now check for the your entry level for a sell. And there are some things you want to look out for depending on the trader. Some people, they are looking out for an order block. Some are looking out for a breaker block. Some are looking out for a fair value gap. Some people are looking out for a liquidity, depending on the confluence you usually use before you enter a trade. Because as a trader, you should have some criteria that you must see before you take a trade. So you don't force trade. You allow the price to come to you, then you take the trade. So it depends on the criteria that you look out for that has been working for you. So whether it is a breaker block, another block, a fair value gap, liquidity sweep. So depending on whatever you are looking for, or candlestick pattern, you understand? So now let's go to the chart and then let's go to the chart and look for examples. So that I can use that to portray what I'm trying to say. So we're on the 4-hour time frame. Okay. Alright, this is AUJPY. So we're on the 4-hour time frame. This is AUJPY. Now if you look at what we have here now, you will see that we are having a supply zone here, a demand rather. Okay, let me use the shorter. So this is so I want to buttress what I just explained to you so that you know that okay, these are the things that are happening in the charts. So now we have, this is on a 4-hour time frame. Don't forget that in Forex, once you start your analysis, you are starting from the higher time frame. There's something we call top-down analysis. It means that you're analyzing the market from the higher time frame, then you are coming down to the lower time frame to take your entry. So you can either start from the weekly or the daily or 4-hour or 1 hour. Then you can come down to either 15 minutes or 1 hour or 10 minutes or 5 minutes to take your entry. So I'm starting from the 4-hour time frame. And the reason why we are starting from the higher time frame is for us to have an overview of the trend of the market. Once you go on the higher time frame, you have an overview of the trend of the market, so it will be easier for you to trade. Understand? And it's always advisable that you trade according to the trend. You follow the trend. So that is the easiest way to make money from the market. So look at what we have here now. You can see this is 4-hour time frame. You can see that. Look at what we have here. We have a demand and supply here. This is our demand or support. This is our supply or resistance. So you can see that price has reacted. Can you see? Let me show you. So price, you can see price got here and reacted, went up, got here too. Can you see? It broke out. This is a false breakout. There is something we call false breakout. Yes, and this is a false breakout. Broke out, then came back again. We tested it level, came back. Then got to this demand. This is also a false breakout. Can you see? Then if you want to learn more about false breakouts, you register for my one-on-one mentorship. So so you can drop that in the comment if you're interested, or you can look for the link in this video. So you can connect with me and register for my one-on-one mentorship. So now you see false breakout. We got to this level, we tested it, came back to test this level. Can you see? Now it couldn't even break out of this level. Came back to test, came back again to this demand. Can you see? Then came back here, went up, tested this level, couldn't break out, then came back down. Can you see? Got to this level, range for days, then started going up again, then finally broke out. So can you see, broke out, came back to the test and went up, came back again, then before you now finally would continue the uptrend. So you can see the build up. So price has tested this level once, has tested the second time. So once you discover that price has tested the level more than once, what you want to do is quickly look for your horizontal tool and draw it you draw it on that level. Understand? You are drawing it out, anticipating that okay, that price will come back to retest it in the future, or once price comes to test that level in the future, and is already giving you a bullish interest, then you want to look out for an opportunity to take a buy. And that's the same thing that happened at this supply level here, or this resistance. Price tested it, came back, bounced back, tested it again, bounced back. Can you see? Then you've drawn your level already, waiting that okay, once price come back again, you want to sell, and you can see the same thing happen there too. Can you see? You can see the same thing also happen there too. But now this is on a 4-hour time frame, so you don't want to enter your trade on a 4-hour time frame. So what you do is that 4-hour time frame, you have been able to use it to identify the supply and the demand. You have been able to identify the key level. So you now want to come down to your 1 hour. You want to come down to your 1 hour. You want to come down to your 1 hour, or you want to come down to 15 minutes. Now, why are you coming down to 1 hour and 15 minutes? The reason why you are doing this is that you now want to look for your entry level. You understand? Now, 4-hour or daily has told us the direction, what the market is doing. Then we now want to come to 1 hour 15 minutes. Now, the reason why we are coming to 1 hour 15 minutes is we want to look out for our entry level. You understand? We want to look out for entry level. Now, what do we need to do, or what are we looking out for? What are the confluences that we are going to look out for before we can pick our entry level? Like I said, you can either use order block, breaker block, fair value gap, liquidity sweep, candlestick pattern, psychological level. So people have different strategy they use depending on the trader. Understand? But as for me, I usually come to 15 minutes time frame to pick my own entry. So me, I come down to 15 minutes time frame for me to pick my own entry. Understand? So and most times what I majorly use is I make use of the liquidity sweep, and sometimes I make use of a candlestick pattern. Yes. So if you want to learn more about how to now identify this on a lower level, on a lower time frame, so that you can now take your entry. So you also have to register for my mentorship class. You understand? But I've been able to give you the overall view. You understand? From the higher time frame, determine okay the trend, and you spot out. Then you come down to your 15 minutes or your 1 hour. You understand? You come down to your 15 minutes or your 1 hour. Then you now be able to spot. You'll be able to spot where you are going to take your entry from. Understand? You'll be able to spot where you are now going to take your entry from. Like for instance, now this trade I took to this date now. This was a buy. So you can see this was a buy that I took. So I waited for a pullback. So for this buy now, I used my liquidity sweep. Can you see? Price came down. If you zoom it very well, you see that price actually came down here. So if you look at this, so you see that price actually came down to grab this last low. This was the last low. So there was a liquidity sweep here. Then price started going up. So when I saw that it started going up and I saw how LD this candle is, I quickly entered my buy here. I took my buy from this place. I used my liquidity sweep. But I'm still going to come back to explain the entry level to you. So let's just go ahead with so now so that is that for that. Now I'm also going to be explaining to you alright, so this was where we were before. So so we've looked at key levels. So at least I've been able to explain to you the meaning of key levels and some of the terms that has been used. So now I'll be explaining to you the importance of key levels. Number one, it helps traders identify entry and exit points. Like I told you, you can see these are key levels. So as a trader, you do your overall analysis of 4 hours, then you put out your 1 hour 15 minutes to now identify your area of interest. You understand? Or to mark out the key level. You understand? So, but you at least you've been able to identify the bigger level first from the higher time frame. Then you now go to the lower time frame. You understand? So now identify your entry, where you are going to enter the trade. You understand? And where you are going to also close the trade. So it helps traders identify entry and exit points. Number two is that it helps to review where big institutions place their orders. So these levels now, they are levels where big institutions they place their orders. You know, there are bigger market players, central bank, commercial banks, hedge funds. These are people that they are trading in bigger volume, larger volume than retail traders. They trade with thousands, millions of dollars, billions of dollars. So their trade alone moves the market. And there are places where these people have placed their orders already. So the key levels to help you to identify those places. Then another importance is that it helps to improve your risk management. Once you know that you have identified your key level and you have also identified your entry level, then you know where to place your stop loss and your TP. You know where to place your stop loss. So for instance, now if you are taking a trade, let's go back to okay, for instance now this is Euro USD. Can you see? So this is a support level or a demand level that we have here. For instance, now this is like a support level. Understand? So for instance, now if you are going to take a trade on these charts, you are going to be taking a trade on this chart. You want to come down to your 1 hour time frame or your 15 minutes. Understand? So let's assume. So now let me look at this trade I took. This was a trade I took. It was a winning trade for me. So I've been able to identify this level. This was the last low. Then you can see liquidity came to take out. Let me remove this. So I see that there was a liquidity sweep. And you see it's weak. There was a liquidity sweep that came to take out this last low. Immediately we had the liquidity sweep and we had this candlestick. I already knew that okay, this is a pin bar. So I knew that okay, this is going to buy. So I took my buy. Exactly. So this is on the September 12th. So I took my buy from here. So if you go down to a lower time frame, you will see my entry levels very clear. So I took my buy here. Then I make sure that my stop loss is below this week now that I got rejected. I make sure my stop loss is below it. Can you see? And also my take profit is around this area. So if I go down to the 15 minutes here, here we see what I'm trying to explain very well. You understand? So that is another function of the key levels. So key levels will help you to know where to place your take profits and also where to place your stop loss. Where to place your trade and stop loss. Understand? So now another thing is it helps you to confirm trend, continuation, or reversal. That's another important point. It will help you to confirm trend, continuation, or reversal. For instance, now if you look at this example we have here now, price mitigated this level, but it didn't break out. It mitigated and bounced back, mitigated and bounced back. But if you look at the example from this chart here, you will see and see price mitigated this level. Price mitigated this level and bounced back. it got here, mitigated it, it broke out, but like I said, this is the first breakout and bounced back, mitigated, broke out and bounced back. This one there was no breakout, came down, there was a breakout here, can you see, bounced back, no breakout here, came down, then it broke out a bit, then bounced back. Then you will see that it broke out here, it broke out from this level, then came back to retest it, right? So this is a break and retest. There is a principle called, or a strategy called a break and retest. You can see it broke out, retested it, but you see that other ones that broke out came back into the zone or into the range, but this one broke out, instead retested the level. Can you see? Broke out, retested it, broke out again, came back to retest it, then started what's going up. Can you see? So marking out key levels or area of interest help you to know whether a trend is ranging, or whether the trend, or whether a market is ranging, or whether a market has now continued trending. So that's another importance of key levels. So it is not something that you want to take, and I tell you, once you are able to know how to identify these areas, I tell you, you don't have issues. And like I always say, Forex is not hard, you understand? So they are just the basic things that people take with levity, you understand? Forex is not hard, it's not difficult, you understand? So it's important that you pay rapt attention. Like when I was learning, during my learning period, before I became profitable, there were times that I'll watch some videos, I'll watch them just once, then I think I've gotten it. But I discovered that there are some videos you have to go and watch over and over again and practice. So I watch video just once or twice, then I go to practice, but I still discovered that I was still making a lot of mistakes because I was rushing the process. You understand? I was rushing it. So as a first trader, you don't rush the process. So there are some videos you watch once, twice, you go and backtest, and you start trading. Then if you are not still getting, you still go back to watch them again and again and again. And that is why we have videos like this for you, so that you can always come back to the channel and watch again and again and go and backtest it. You understand? So there are some videos I watch like 5 times, 6 times, 7 times. Even after backtesting, I watch them a lot of time before it now stick. I know that, okay, these are the things I look out for before I can enter a buy or sell. You understand? So there's nothing really hard about it. So now that is that for that. Now, we're also going to be looking at some other important things here, and these things are very key. We are still looking at how to identify key levels or area of interest. How to identify key levels or area of interest. So now, I want us to note that in a downtrend, the high sustain the trend. That is, the high must not be taken out, and vice versa. So that means that in a downtrend, the high sustain the trend, the high must not be taken out, and vice versa, meaning that means in an uptrend too, the low must not be taken out. So now, what do we mean? What are we talking about? For instance, look at what we have here. So I want to zoom this for you to see. Look at what we have here now. This is a downtrend. As you can see, we have the high, low, high, low, high and low. Can you see? Lower high, lower low, lower high, lower low, lower high, lower low. Now, this is an external liquidity. This is also another external liquidity. Now, this external liquidity is expected to be what? To be taken out. Can you see? Lower low, lower high. This is a new low that has taken out this last low. Can you see? So these lows are weak lows. So that since it is a downtrend, they are expected to be taken out. I'll come again. Lower low, lower high, lower low, lower high, lower low. Now these lows, this low and this low, they are weak lows, and they are also called external liquidities. So since we are in a downtrend creates series of lower lows and lower highs. So we have the first break of structure here. So we have the first break of structure here. We also have the second break of structure here. Can you see? So now, since this last low has been taken out, this is an external liquidity. So it is expected that the low is taken out because it's a weak low and it's a downtrend. Now, look at this one also. This low too has been taken out, is an external liquidity. Now, in an external liquidity or in a downtrend, the high sustains the trend. Understand? This is one high here. The high sustains the trend. This is the first high. Can you see? This is another high. Can you see? This is also another high here. This high here. This is another high. So we're already having three highs here. So this high now in a downtrend sustains the trend. Now what do we mean by that? We mean that this high must not be taken out. Can you see? In a downtrend, this high now this is the first high, second and the third. So we are on the third trend now. So if we are going to be having a reversal, please listen attentively. This is very key, and once you get it, I tell you. So now look at this reversal now. This reversal now is meant to either get here or here and come down. But imagine this reversal got here and it continues to go up and it continues to go up. That means this reversal now has taken out this last high. Now this high, don't forget, is expected to be protected. In a downtrend, these highs are expected to be protected, but in case we have price now retracing back and go to this high and continue going up, that means we are already having a change of character. That means that we are already having what? A change of character. Please, are you getting it? So it's very simple. We are already having a change of character. Alright, so now let me come again. These highs are protected highs in a downtrend. They are not expected to be taken out. But once we have a pullback, and now take out the last high. Once you have a pullback that takes out this last high, that means that it's already giving us a sign that we are likely to have a change of character. Understand? And that's the same thing for an uptrend too, but I'm still coming to okay, that's the same thing for the uptrend too. Now if you look at the uptrend, we see that we have impulse correction, impulse correction, impulse. Can you see? So now in an uptrend, the lows sustains the trend. Can you see? This low sustains the trend. Now this is the last low before this impulse move that took out this external liquidity. Now in an uptrend also, these are external liquidities. All these highs, they are expected to be taken out because they are weak highs and they are external liquidity. So it is expected that once you have an impulse move, you can see this high now has taken out this last high. So it gives us a new high. So now we had a pullback or a correction. Then we had another impulse. This new impulse now has taken out this last high, giving us a new high. So it is expected that in an uptrend, the external liquidities are to be taken out. And in an uptrend, the lows sustains the high. Then this lows now. The low sustains the high, don't forget. the low sustains the high. Don't forget the low. So now this is the first low, second low, third low. Now this is the last high. Then if we have something like this now, imagine we had a pullback. So a pullback is supposed to get here, either get to this flip zone and move, understand, or either get to this strong zone, strong low and move. But the situation whereby the pullback now got here and broke this last low, then that means we might be having a change of character or a change of trend. So we might be having a change of character or a change of trend. So now the lows, like I said, sustains the high, and these are external liquidity. They are weak highs and they are expected to be what? To be taken out. They're expected to be taken out. So now if we look at, so now we are still looking at how to identify key levels. So in downtrend like this, whenever you're having a downtrend, this is lower low, lower high, lower low, lower high. So this structure has been broken, this structure has been broken. Now this is now the last high. This is the demand that took out this low. So this is where you target. Don't forget, this is the demand, this place here. This is the last high that took out this low. So whenever this low is broken out, you locate the demand that took out the low. Now this low, which is external liquidity, has been taken out by this price. So now, where is the demand that took out? Where is the supply that took out this low? This is the supply. So you want to focus on this area. You want to focus from here to this place. Since it's still a downtrend, you want to focus from here to this place. So let me come again. Whenever a low is being taken out in a downtrend, you locate the supply. Whenever a demand is being taken out, you locate the supply that took out the demand. So this demand here has been taken out by this supply here. You can see it came down, took it out. So you locate the supply. So where we are concentrating our effort on now is from this high to this low, because now we are expecting that price will reverse and come back down again to take out this. Price will reverse and then continue going low. That's what we are expecting. So we are now concerned about this supply that took out this low. So now, and since we are now this supply that took out this last low, so now, and it has created a new low. So now, since we are still in a downtrend, we are expecting that price will reverse back, then continue going down. As I said, price will reverse back, you understand, and what continue going down since it's a downtrend. Now the question is, where will this price get to before we start coming down? Where is the retracement going to get to? Where is the correctional movement will get to before it start coming down? Or where are you supposed to anticipate that it's supposed to get to? Now don't forget that when we looked at our Fibonacci 2, so I explained to you, if you have not watched that video, if you have not watched my video on Fibonacci 2, please check my channel. I did an extensive explanation of Fibonacci 2. So please go and watch it. I did an explanation of Fibonacci, extensive explanation. Please go and watch that video from the beginning to the end. Once you watch that video, you won't have any issue with Fibonacci 2 anymore. In fact, you can watch it and even start teaching other people. So we are looking for a retracement. So now, that retracement for the Fibonacci 2 We are looking for 50%. Don't forget. We are looking for 50% for the retracement. So we are looking for 50%. And if you look at what I just drew now, 50% is from here. Can you see? So we are looking for 50%. It's from 0.5. 50% is, let me remove the Fibonacci. At least I've placed. So this is 50% is from here. Now this place is discount. So yeah, you want to sell from here. You want to sell from discount. You don't want to sell anything 50% and above. You want to sell because that is where it is. So now we have two zones here. We have the flip zone or secondary point of interest, and we also have the strong high or primary point of interest. We have the flip zone or secondary point of interest. We also have the strong high or primary point of interest. So now for this retracement, we are expecting that the retracement will get to, it will cross this 50% Fibonacci level. Then once it crosses this 50%, that means you want to buy from 50% and above. It means that you want to buy from anything from here. So you want to buy anything from here. Can you see? You want to buy anything from 50% and above. So this circle now, that's where you want to buy from. Anything from this circle you want to buy. So price is expected to reverse. Once price crosses this 50%, then you can either buy from anywhere inside this zone. Are you with me? Buy from anywhere inside the zone. So this zone now is a discount zone. Don't forget. This zone is a discount zone. Sorry, you want to sell from discount zone. I said buy. So you want to sell from discount. So you sell from discount. You sell from discount. You want to sell from discount. But this is a downtrend, so you want to sell from this zone. Understand? So that being said, so the next thing you now want to do is that you now want to look out for your flip zone or your secondary POI, and also your strong high or your primary POI. You want to look out for your flip zone or your secondary POI or your strong high or primary POI. So now, when it comes to this, what you want to do is that you want to anticipate two zones ahead, two zones that have crossed the 50% Fibonacci 2 level. Now this is the 50%, and this is the first zone, which is the flip zone. Now this is now the last, the strong high or the primary point of. Now this is the last high. This was the supply that took out this low. So this is the last, the strong high or the primary point. This is the flip zone or the secondary point. So now price can retrace back here and start coming down. So now you now want to anticipate in advance two zones ahead. The price can either get to this level. Can you see? So you want to anticipate, okay, price can either get to this flip zone or strong high. Can you see? So price can either get here price can either get here price can either get here and start coming down so that you can sell, or price can get here and start coming down. So you anticipate and you bring out your short position. Can you see? So I'm showing you how I trade. Most times I anticipate this is what I do. This is the first point of interest, and this is also my what? This is my first point of interest. Now, this is my second point of interest. Right? Now, the reason why I'm having this, so most times I usually have two points of interest or two zones. Now, this is the first one and this is the second one. So the first one is on the flip zone, can you see, or the secondary POI. The second one is on the what? Is on the strong high or primary POI. So what this means is that once price, please, I need it to be following me, please. Once price will trace back, is either price gets here to the flip zone, then it gives us a bearish trend so that we can sell, or price gets to this strong high and gives us what? A bearish interest so that we can what? We can sell. So these are my anticipation. Understand? It's either price gets to the flip zone and gives us a bearish interest and sell from there, or price gets to the strong high. Now this strong high is the last high because it's expected to be protected. But if, for instance, we now have price did something like this, price got here, took out, got here, broke out, and it now broke out this last high and continue going up, then that means we might be looking at that, and there's now a change of trend or a change of character. Maybe try to now do something like this, break out, we test, then it's now going up. That means there's now a change of trend from a downtrend to an uptrend. So that is the explanation for this. So we have the flip zone or the secondary POI, so the strong high or the primary POI. So the flip zone is the first zone after the 50% Fibonacci level. Understand? So price can either get here and give us a bearish intent, we say. If it doesn't give us from here and it continue going up, then this is our second point of interest. So we'll come to wait for price here. And if it gets here and it's coming down, then we want to sell. Understand? So if you take a sell from here and it took you out at first, you can come here again and look for another entry level for a sell. So if you take another sell and it takes you out again, that means that price is now going up. That means there's likely to be a change of character. And that's the same thing to apply to a downtrend. So the same thing to apply to an uptrend rather. So you can see that in an uptrend we have the high, low, high, low, high. These are external liquidity, and these are the lows. So in an uptrend, the lows sustains the high, meaning that the low shouldn't be taken out. And see lower low, lower high, lower low, lower low. Okay. So higher low, higher high, higher low. This higher low, higher low, higher low. So they must not be taken out. Understand? So now if we are still in an uptrend, we are expecting that we have a pullback, either to get to this level and go up, or get to this level and go up. But we are not expecting that it to come down lower than this. When this is broken, that means that we are now likely to have a change of trend. We are not likely to have a change of trend. Understand? So now, for the retracement for this, now we also make use of our Fibonacci 2, because we are looking for 50%. So you do this. So your 50% is there. You click on your 0.5. So we can remove the fib 2. So now you want to buy anywhere from discount. Can you see? So you want to buy anywhere below the 50%. Yes. Anywhere below 50% is where you want to buy from. So this place now is your discount. You want to buy anywhere from here. So now, the reason why we are buying from discount, normally you buy from discount, understand? So if you are buying from, this is like a premium zone. This place, anywhere above 50% premium. If you are buying from here, it's too risky, because price can retrace back deeply. And in price, if you buy, that means you are buying too early. If you are buying from premium, that premium price is too expensive. You allow it to go down. Just like in crypto now, the best time to buy coin is during a dip. Where there is a dip, when everybody is scared and they want to sell, that is the best time to buy. But when the market is booming, that's not the right time to buy. At that time, the price is high already. So you might not even make anything. And even if you are going to make, you won't make much. So the best time to buy is when the price is deep, is in deep, you know, when the coin has gone down. And that is when you buy. Then you now wait for it to shoot up. Then you make your money. So you can see there's a what's it called now? So we are expecting that price will come back to discount. So you can buy anything low from 0.5 below. So I see you can buy from here. Now we now have two zones. We have two zones here. So we have the flip zone and we have the strong low. Now in an uptrend, the low sustains the trend. So this low now, this is the last low. This was the low that took out this external liquidity. So your focus is now on this low and high. Now this is an uptrend. We are expecting that since this external liquidity has been taken out, we are expecting a pullback. You understand? We are expecting it now. We are expecting a pullback. So now we want the pullback to come to cross this 0.5 and either get here or to this low. So we are either buying from 50% below. Understand? So what we now want to do is that since we have these two levels here, so it is good that at least you have two levels ahead. Like I said, there's nothing wrong with having two levels. So you can't be that perfect that you know where the retracement to get to, although there are some confidence you can actually use. You know, if you want that, I know I'll register for my one-on-one mentorship. I'm going to teach you on that. Understand? So now what you are looking for is that this is now the flip zone and the stronger. So price can either get here and continue going up or get here. But if price gets this place and continue going lower and breaks out of this and take out this low which is protected, then that means that we are likely to have a change of trend to the downside. You understand? So what you want to do is here is that you want to is that so you want to anticipate your levels down. Okay, maybe this is your first POI and this is your second POI. Are you with me? So you're anticipating that price might get there. But don't forget that in even choosing this POI, you must have gone down to your lower time frame, which is 15 minutes. For me now, my own is 15 minutes to choose this POI, because there are some things you must be looking out for. Most times I look for liquidity sweep. So you must have gone down to your lower time frame. Understand? You must have gone down to your lower time. So once you have gone down and you pick these two levels, then you come to your long position, you understand, then you place it here. You also place it here. So this is for your long, this is for the first flip zone, that in case price gets here, you understand, with your stop loss. You must always set your take profit, and your TP must be you can see this is your TP now. It must not be higher than this last high. At least it must be on the same line with this last high, because the next impulsive move will take out this high. So to be on the safer side, make sure it is on the same line with it, or at least a bit higher. This is 1:2. Then you have the second one too, which is this. In case price doesn't respect that level, in case price breaks out of this level, then this is the second point of interest that price is expected to respect, and use the second point. So what we are expecting price to do is that we are expecting that price will come down, get to this level, then continue to buy, or you see, or we are expecting that price to come down, and you see, get this strong low, and we will continue to buy, and you see, you understand, this is what we are expecting that price is going to do. But in case we now have price break out this zone, also took out this zone, and continue coming down like this, and it has taken out this low. In case you have something like this, then we will now be anticipating that, okay, that means we are having a change of character, because price can come down, take out this low, retest, and then start going down. So that means we are now having a downtrend. And also, another thing you should know is that sometimes the market can be deceptive in such a way that price can even do something like this. Price can come down, take out this low, can you see? Take out this low and start going up, can you see? And start going up. So price can take out this low. Since price has taken out this low, which is protected, some traders might feel that the downtrend has continued, and they will start selling, and it is a false breakout. Price can take out this low, then continue going up. You can see reverse and start going up back. So these are advanced structures that I take in my mentorship class. You understand? So there are times you have such too. So that is that for that. So you can see what we have been able to look at in today's class. So this is what we have been able to look at in today's class. Can you see? Okay, so I want you to go back to the chart and backtest. You understand? Go back to your chart, go and backtest this thing I've taught you. You understand? Go and look at examples. Go and look at different examples of these things that we have done. Okay, this is on a 4-hour time frame. So go and look at different examples of what. Let me look for one more example. For instance, now this is EOG 4-hour time frame. Can you see this is an uptrend? Like I said, the low sustains the high, low. Can you see? high, this is high, this is low, this is high. So you see that the low is always protected. The low is always protected and must not be taken out. Understand? Although there are times where we have the lows being taken out. Maybe if we see any example, I'll show you. Understand? So those periods now when the lows are being taken out, what do you do? So those ones are for my students in my mentorship. Understand? So okay, look at an example here now. This is USD CHF. This is an 4-hour time frame. Now this is an uptrend. And you see we're having the high, the low, high, and the low. And you see. Then we have this high here that broke out, that took out this high. Then you can see this low has taken out this low. And normally this low is supposed to be protected. So you can see where it got to. It took out the low here and it has taken it out. But yet it didn't change character, instead it continued going up. Can you see? That it continued going up. So there are times that the protected low can be taken out, and yet we are still in the same trend. The trend is still continuing. You understand? So I want you to watch out for that. Alright, so this is where we are going to be ending to this class. So if you have any question, I want you to drop it in the comment section. I'm going to reply to your question. And then I also want you to like this video. I also want you to share. I also want you to subscribe to my channel and turn on the notification button if you have not done that. So like this video and then share, and also drop a comment. Drop your points in the comment section. And these activities will help us to want to produce more. And also, if you have a topic that you would like me to also teach, or you want me to talk on, you can also drop it in the comment section, and I'm going to respond to your comment. Alright, so thank you so much. And then, like I said earlier, please go back to this video and watch it, and also backtest. Watch it over and over again, and also backtest until you get it. Understand? Until you get it. Alright, so thank you so much. I'm going to see you in the next one. Bye bye.